All right, day 460, excuse me. Today, we're looking at properties that have come onto the market. Oh, is this 460? Oh, it's 461, excuse me. Oh, I'll change this one later. Today's 461. Sometimes I lose track of how many days it's been. So, day 461 of looking at properties. And today, what I wanted to do is show you how is it when people think about investments and they look at properties, they sometimes think about the worst case scenario as being a complete loss. And I don't think that's ever true. I mean, even if you think about it, right, when you buy a car, that car generally never becomes worth $0, right? There's usually parts that you can scrap for some money. So it rarely ever becomes zero. Just like real estate, there's always the land. You can't ever depreciate what's below the land cost. And similarly for pursuing a BRRRR strategy, if you're looking to do the buy, rehab, rent, refinance, repeat strategy, well, you have to look at what is my floor ARV. And in this case, I'm looking at this home right now. I mean, this pretty much looks like a gut job. I mean, it's assuming everything else works well. Let's see. Are there any notes about this? I mean, even for a big fixer upper like this, it's still being listed for 105. So this tells me in this zip code that for this property at $70 a square foot, that is a good floor price to use for your ARV estimates, which means that you should never expect your ARV to go below $70 a square foot, assuming you're in a comparable neighborhood. Now, what neighborhood is this property in? If I scroll out, this is in Inglenook. So let me write down the neighborhood that this property is in. Because if you remember what we've been doing is we've been looking at properties in this area in Birmingham for properties that have been sold in the last 12 months, right? And then we start looking for properties that have been sold in the last 3 months. And now, most recently, we're looking at properties that are coming onto the market and seeing what they're being listed for and ultimately what they're going to be sold for, because this is very important, right? What is a BRRRR strategy? The BRRRR strategy is if you are able to buy a property for, let's call it 20 grand, and you spend 50 grand, 50, renovating that home, but now you're going to make that home worth 100 grand. Well, now all of a sudden, you can go get a loan for 70% of the home's value. And you can go get back out your $70,000 with $30,000 of equity left in the deal. That's the beauty of the strategy, because now you can rinse and repeat using the same deal, same property, and putting it towards another property in the future. That's why it's so scalable, because what's the alternative, right? The alternative is you saving from your full-time job for a 20% down payment. Buying a home, hoping in cash flows, and then saving it all up for it all over again. And that's why it's such a slow strategy. Versus the BRRRR strategy, you take back out your initial pile of capital and use it over and over and over again, assuming you manage your execution. Wow, 104,900. Now, obviously, what's a perfect comp, right? A perfect comp, in my opinion, is if you have a home that is the similar square footage. Whoops. Same neighborhood, same street even. So let's say 3920, 39. That you might say, hey, if I can get this home directly next to it, it's the same finish, same type, same lot size, same bed bath count. What did that property sell for? Because that's your natural inclination for the perfect comp, but that's usually never the case, right? Usually you cross big main streets, such as this one in Vanderbilt. You might cross different parks. You might cross the airport, and now all of a sudden you're in completely different neighborhoods. That's what's going to affect you. And the accuracy of your comps. So for a BRRRR strategy, if you're looking to do a BRRRR, the ARV is so important because now what you have to do is track what properties are coming on the market. And if you don't get the appraised value that you were looking for, what kind of comps are you going to put forth to challenge that appraisal? So this property up here for 2,148 square foot, this property was listed for $109 a square foot. Let's see if it's still on the market. This property was sold August 8th for $235. Sold for 109 square foot. Lot size is similar, and they're in similar neighborhoods. This one's also in Inglenook. So that's not too far away from here, right? But this home is renovated, right? That's why we're tracking in this market, right? You're seeing that this property is renovated, it's nice, it's modern. So if I were to say, and I'm trying to BRRRR this home, right? And I'm trying to convert this to a 4-bedroom. Can I turn this home to make it look like this home? And hopefully I can get $109 per square foot. And that's a decision that you have to make. But if you're able to sell for 109 square foot or get an appraisal 109 square foot, then max, just using very round numbers there, let's say you get $100 a square foot, you can't be more than $70 a square foot all in. So this property at $70 a square foot probably won't work. You probably want $70 per square foot all in, inclusive of the rehab, not just with the acquisition. So that's how we're looking at past properties now. Taking that information and applying to the property today, especially if you're looking for the BRRRR strategy. That is the difference of, and that's the reason why we're tracking all these properties, right? Because as properties come on, and we're just doing this once a day, right? You don't have to overstress yourself, just stay consistent. Floor needs complete renovation, right? That's how you figure out, maybe if I think my rehab here is $30 a square foot, then the max I can offer for this home is $40 a square foot because I'm trying to get BRRRR'd, right? That's the thought process I want you to get behind. Because for this property, let's underwrite this property now that we wrote down all these details here. So now I can reference this as my floor. This is 104,900, 104,900. This home is how much? 1,500 square foot. So let's go in here. Let's assume that we had to replace the roof for about 15 grand, all exterior stuff, not just the roof. Let's say we got to repaint the entire home, 1,500 square feet, and we got to redo the flooring in the entire home, 1,500 square feet. Let's say we do a total renovation for the kitchen at 10 grand. We do total bathroom renovations for all bathrooms, 1.5 bathrooms. Let's say we got to put in a new AC unit, heater, furnace, $6,500, new water heater, rewired the entire electrical home, about 12 grand. So this gives me right now a total of about 91 grand. I'm just doing really rough estimates, right? Let me delete this times 2. So this tells me this is probably not ideal, but I might be overestimating the rehab, right? Maybe all the guts is good. Maybe the HVAC doesn't need to get replaced, right? Maybe it's all cosmetic. So now if I look at the rents for this home, you can see that for 25 units within a 1.13 mile radius, the average rent is $1,129. This is going to be far, 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 far from ideal. Now, if I were to say this property is $44 of property taxes, $81 for homeowner insurance, I'm going to take 81. I'm going to multiply that by 1.2 because I'm adding a 20% premium to this property by making it an investment property, because insurance companies will view investment properties as a higher risk asset. So that's why I'm adding a 20% premium here. So then I got 10% for my maintenance every single month. I got 10% for my property management, 5% for vacancy. So that gives me with 25% down and a down payment of 26 grand. If you buy it for the 104 at 7.5% interest rate, my finance amount will be equals to my B4, my asking price, minus my down payment percentage of 26 grand. So I'll be financing 78 grand if I bought this property for 105. Assuming I paid all cash, everything else, I could cash flow $155 a month because of how much capital I'm putting in myself on this property. The crazy part is, right? I'm still putting aside 10% maintenance every single month, right? Because I know that the roof, the HVAC, even I'm putting in new things in, they're going to get replaced at some point. So if I don't set aside 10% of my rents every single month for those repairs that I know are coming in the future, I would be underestimating my expenses and overestimating my profitability. That's why it's so important for us to have all these numbers in here, because this is your true number. So if you rent this property out as a 3-bedroom for $11.29, you could cash flow $155 a month, but your cash and cash return is negative. It's 1.6% return. That's because you spent so much capital out of pocket to renovate this home for 92 grand roughly, right? And I would argue for 1.6% return, I mean, that's not really worth it. But again, we haven't taken into consideration what the BRRRR value is, right? What the after repair value is, especially you can pull back out any capital. So let's just underwrite this property today as is, assuming an on the market purchase. All right. So what would I have to buy this property for this to be a 10% return? Do I have to pay 20 grand for it? 10 grand for it? Yeah, 5 grand. Here you go. I would essentially have to buy this property for free for it to make it worth it, right? This is just not even a deal. There's no way I can buy this property for $1,000, right? Even at $1,000, because your rehab so much money out of pocket. 25% down, 7.5% interest rate. There's only a 9% return. And for me, again, that I can cash for $700 a month this way because I use so much of my own cash. But this is not worth it, right? At 1.6% wasn't worth it, because why would you go through all this execution risk? What's execution risk? Is your contractor gonna show up on time and do what he or she said they were gonna do? Maybe not. And that's the hard part, right, about all this stuff. Why would you spend all this money, all this effort for 1.6% return on your capital when you can go buy a 10-year treasury yield for 4.5%, right? That's a problem. That's why we track all these properties coming on the market, especially if you look at if you understand what drives the 30-year mortgage interest rates, right? You have to understand that the 30-year mortgage interest rate is really heavily driven by the 10-year treasury bond. And it's driven by two things. One is the interest rate of the 10-year yield, which is 4.75, but you've seen it fluctuating from about lows of 3.3 to 4.6, almost 5 points. But also the spread between the 10-year yield and the 30-year mortgage interest rates. Historically, that spread has been about 1.5 to 2%, but it's gone as high as 3%. But now that the spread has narrowed, you can see why it's gone back up to 4.6-ish, which is roughly in line with the yearly highs. But you don't see 30-year mortgage interest rates back at 8% because the spread has narrowed. Okay, so that's why we track properties that are coming on the market, because as interests go back up, is it affecting the dollar per square foot? And this ultimately affects, hey, if you understand that this property won't be a deal, buying it conventionally on the market with a traditional investment loan, might it be a deal if you do the BRRRR strategy? We'll find out. All right. So hope you all had an amazing Happy New Year. I hope you guys will stay consistent with me. My hope is that you stay consistent with me and you analyze the same deals I analyzed today using the same spreadsheet. You guys can go to affordablehousing.io, go to the Get Deal Analysis tool, plug in your name, your email, your phone number. That's the fastest for you to get a copy of the spreadsheet. My hope is that you start your own YouTube channel. You put it on your own YouTube channel, because at some point someone's going to ask you, hey, why do you think this is a deal? And you can go to them and say, hey, I know that this is a deal because I've been looking at properties for the past 462 days, 461 days. Might that give you some confidence that you know what you're doing? I certainly hope so. All right. I hope you all have an amazing weekend. I'll see y'all tomorrow for day 462. Have a good one, everybody. Again, this is not investment advice. We're not soliciting any investments on this call. Please consult your own investment professionals for any advice. I'll see you all tomorrow. Have a good one.